Yesterday we looked at the stock market, today we are looking at the housing market. Welcome back. This time we're looking at the great housing market collapse which could be inbound. Let's have a look at what the key data says in this video, and we're going to be asking the question, is the market inbound for an utter collapse and utter chaos? Well, before we dive in, the same applies. This is opinion based on facts. Again, all of the data that we are going to be looking at will be analysed throughout the video, so feel free to watch all the way through. And it took me a long time to compile all this data, so it is going to be quite a thorough and rigorous video. Regardless, we're going to jump in right now, and we're going to start off as usual in the beginning. It's always a good place to start. What we're looking at here is the key data. Let's familiarise ourselves with it. So, many analysts are warning of a catastrophic market correction in the housing sector as house prices have skyrocketed in the past few years. Both the price of rental properties alongside owning houses and the price of the underlying asset has increased starkly in recent times. We'll be looking at this more in a moment. This is a quotation that I found from the NewYorkFed.org. And it says mortgage balances rose by 207 billion in the second quarter of 22, and then they stood at 11.39 trillion at the end of June. So credit card balances have also increased by 46 billion. Now, if you watched our last video, we did briefly touch upon this, but I think it does kind of bear more interest to the housing market than it does to the stock market, essentially. And we'll talk about this and more in a moment. But let's have a look at some key data on a few charts which I have managed to find for you guys. Now, the first piece that we're looking at here is the average 30-year fixed mortgage rate. Now, we're seeing this increase in April of 2022, which is the most recent data, coming all the way up to 5.49. Now, we haven't really seen rates like this on the chart, which starts at 2017. Again, the highest thing that we have seen was back in 18 coming into 19, so I would say the January to February period where we saw 5.2%. Again, we're now seeing higher than that, and the question is, well, what effect is this going to have? We'll be touching upon this more in a moment, like I said, but I just want to provide this data first and then we'll analyse it in a moment. Now, touching on this a little bit more, we have some factors which generally affect mortgage rates. We're looking at things like inflation, again, we all know about that right now, the rate of economic growth, again, somewhat similar to the last one, the Federal Reserve monetary policy, and the bond market, alongside the general housing market conditions. Now, all of these things are things that we're seeing on the news a lot recently. Inflation is crazy, we all know that. The housing market conditions, well, we'll touch on them more in a moment. The rate of economic growth, well, we know where that one's going, and of course the Federal Reserve monetary policy is something which is very key to this, and we are going to be talking about that more in detail in just a moment. But I do want to focus on a few of these other charts first. So this is the House Price Index in the US. We're seeing how this is going. This chart is coming from Economics Help, and it starts all the way back in 1987. So look at what we're seeing, okay? Steady increases throughout the 80s, coming into the 90s, coming around to 2000, coming into the mid-2000s, we saw this one really start to spike. And what happened then? Well, 2006, 7, 8, 9, we saw the market crash. We came all the way down significantly, and again, it didn't really take that long to recover. Coming back into 2013 roughly, we started to see this recover. But what's really interesting is, coming out of that period into 2017-18, we saw a very steep increase, but really it all started to kick off in 2020, where the prices, like I said, have really started to skyrocket to levels that we just have not seen before. Now, the reason why this is so key is because the house prices are going up, but what's happening to the people's pockets? And this is really crucial because a lot of people are taking out houses inevitably on mortgage, which makes sense, but obviously the question is, how are they going to be able to pay for that? So the US house prices versus earnings, right? We're seeing this reach levels that we haven't really seen in some time. The last time we saw something like this, oh surprise, surprise, 07, 08, coming into that period. It all started in roughly 99, like he said, all coming to a head in 07, where we started to see this one really decline rapidly. And again, right now we're coming to a point now which, in my opinion, should be concerning. Again, this is a credit crunch of 07, 08, but before that we can see the recession of 81. Again, we saw higher interest rates there. And we'll be looking at this data more in a moment, but I think this is all fascinating. And the reason why I think it is so fascinating is because when we think about debt, we're taught in school that debt is a bad thing, okay? But debt is not always a terrible thing. It allows people to afford and gain access to privileges which they could not necessarily afford otherwise. So we're thinking about things like nice cars, university education, but obviously houses as well. Now, housing debt, as it is called, often manifests itself in mortgages because, like we just touched on, people can't afford the amount of money it's going to cost for a house up front. Now, again, there's nothing necessarily wrong with this, but rapidly climbing household debt, specifically mortgages, can be a dangerous thing. And again, going back a couple of slides, what we see is mortgage rates and credit card balances increasing rapidly. That's key. That's very key. So coming back to where we are right now, we're going to be looking at some factors which could influence a crash. Now, these are things that we would, generally speaking, expect. So it's simple logic here, such as things along the lines of rates. Well, how's the rates going to affect people? Well, let's think about it. The inflation rate, how high inflation is going, and we're seeing that rapidly increase right now. And that's, of course, compared to the interest rate, how much money people are making on their savings, or rather how much they are spending in things like the mortgage rate. But yeah, interest rates aren't really rising at the same rate as inflation. So inflation really out of control, and this is affecting the amount of money that all people have, from the richest to the poorest. You know, our real terms income has declined steeply based on the inflation uptick that we are seeing recently. And again, what we're seeing now is the potential of a recession. And when we're in a recession, where's all that money going to come from? And that's talking about from employees, but also from employers. So what we're seeing from employers is, well, you know, we're seeing the price of things going back up. We're seeing the price of things rocket drastically. And companies are going to be wanting to make cuts to maintain profit. And what's one of the first things that they are going to be cutting, and that they are cutting, as we have already seen? Well, it's employees. We see a mass employee layoffs, and this is a cycle which all kind of goes back up and up. So we've seen the rates increase, and of course inflation going up. It's going to be harder for companies to make money. Then they're going to see layoffs, then of course a recession because people just have less money to begin with. And what's going to happen when people get laid off? Well, the layoffs that we are seeing, we're hearing all the time about job shortages, but these jobs are not in the highest paying sectors. What we're seeing is, you know, job shortages in low paid sectors because, simply put, nobody wants to do the work at that pay rate. So it's not those jobs that are getting cut, it's the middle class jobs, if you will, that are getting cut. And these are the jobs where people feel a level of security, i.e. the sort of people who may have mortgages. So you see how this is all tying in together and looking to cause the perfect storm. So in summary, the summary of the data which we have collected here, it has been quite concise, but I think we covered a lot of good stuff here. To make it clear, I am not here to tell you what is coming with any degree of certainty. I'm not an expert, I'm just somebody who's here to analyze the facts as I see them. I'm no genius, this is just my theory, so do not take this as any degree of, you know, certainty as to what's going to happen. But what we're seeing now, in my personal opinion, it is causing the perfect storm. Again, the main factors I have highlighted here. We're seeing record prices of houses, of goods. Again, that's all going to be affecting the amount of disposable income people have, the amount of income people have to spend, whether that is on goods, but also on houses. So we're seeing low interest rates. People's savings are not increasing. That's not a good thing because, again, we're seeing cuts because of the inflation in real terms income. And again, going back to that point, high inflation, I just touched on that. Job layoffs, again, people who had decent paying jobs no longer will do for some of them because they will be cut. And then the question is, what's going to happen to them? So we've seen increasing debt, again, mortgage, household, credit card, all that sort of stuff is going up rapidly. And there's a spiraling so-called cost of living, i.e. the cost to have a decent life. We're seeing the price of key assets going up around the world. We're seeing the price of petrol or gasoline increase steeply. We're seeing the price of consumer goods on the shelves in supermarkets rise. And again, that's all going to affect the amount of money people have to spend. So let's talk about what's going to happen if people get into a position of perhaps destitution where they just can't afford to pay for their mortgages. Now, what we're going to be seeing is, and this is coming from the source which I have included below, is saying that you still, if you fail to pay, basically the bank can take possession of the property and ultimately sell the property under the terms of the mortgage agreement or by foreclosure. Any costs incurred by the bank when selling the property is going to be added to the amount that you already owe. And again, that is in the instance that somebody defaults on their mortgage. And that's the thing. Okay, so when we have a scenario where people are potentially going to be defaulting on their mortgages in quite decent numbers, because that is what a lot of people are predicting, in the sense that we're seeing the perfect place where not just a couple of people, quite a decent amount of people will just not have the money to pay for these things anymore. What are we going to see then? Well, we're going to see these houses again being sold back on the market. But then you see the market that we have. Well, we have a very high market, a very high price valuation. We have earnings which are not going up at the same rate as house prices. We have inflation, and all of these things are going to impact the amount of money people have to spend. So when we see all this happen, is the demand for houses going to increase or decrease? In my opinion, and I think a lot of experts do also agree with this one, I think it's looking like a place where we could see, the demand for properties decrease because nobody can afford it. And what's going to happen when the property values decrease? Well, it's as simple as supply and demand. A lot more houses on the market, a lot less people able to afford them. And I do think whilst it's going to be painful, these rises that we're seeing in house prices are just unsustainable. We've had a 10 plus year bull run on the housing market. And where does that end? It's not going to go up and up forever, and it has gone up so steeply in the past couple of years. And the factors for it to keep increasing are just not there, in my personal opinion. Now, if you have a different opinion, I'm more than happy to hear it in the comments section. I do hope you enjoyed the video. Of course, if you did, do make sure to subscribe and share it, because we're making more of this sort of content, and I do quite enjoy producing it. So if you enjoy seeing it, again, subscribe and share it so more eyes can get on it. Now, thank you so much. I'll see you all in the next one, which will hopefully be out tomorrow. So I'll see you all then.